It's always been a mystery to me, right? Because everyone seems to have, depending on who you talk to, a different price to earnings ratio. So what's the big debate here?
Well, this is a debate that's been raging for a while, albeit in the more wonky sections of the market.
Right.
But, you know, basically you have your traditional price to earnings ratio where you take the price of a stock or an index, divide it by its earnings per share, either from the last year or the estimates for the year going forward.
Yeah.
A lot of other people like to look at what they call the Shiller PE, which is instead of just looking at 1 year of earnings, you look at 10 years of earnings. And
you average that out?
You average out those earnings,
Okay.
So you divide the price by the average of 10 years of earnings. It's actually a concept that dates back to the 1930s and 40s with the securities analysis textbook from Graham and Dodd, a very famous, sort of seminal work of fundamental analysis.
Right.
But everyone calls it the Shiller PE because he's got the website with all the data.
Right.
Robert Shiller, the Yale economist. And so the Shiller PE is about 27, and the traditional 1 year PE is about 19 on a trailing basis, about 18 on a forward basis. Both are above average. The Shiller PE is a lot more above average than the 1 year.
Clearly, yeah.
Right, and so that has.
And the average is what?
Well, the
average,
and that again is another source of debate.
Like,
if you take
why go down this rabbit hole?
I know, really. It's a Friday. I should have even brought it up.
It's like, forget it. Okay.
But if you go back through the lifetime of the data available, the average is about 16. So compared to 27, that's pretty low. Some people, Jeremy Grantham likes to look at only since the Alan Greenspan era, and then the average is about 24. So above, but not quite as high above.
So this is really important. Obviously, this is very important because people take this as whether it's a buy or a sell signal.
Right.
So have people used the Shiller PE as a buy or sell signal?
They are worried about valuations based on it. And the people who sort of dismiss it say, look, if you look at the last 10 years of earnings, we had some really bad years during the financial crisis. And those were anomalies. Possibly. It depends on how you look at those years. Were they anomalies or were they a normal part of the business cycle that we could see again? And a lot of people choose to believe that they're anomalies. And one investor, Laszlo Barini, actually looks at it and says, look, this thing, the Shiller PE never flashes a buy signal. He says, even at the beginning of the bull market, it was above average then. And the reason then was not only did it have the bad recession financial crisis earnings in it, it also had some bad years of earnings during the dot-com bubble. So even, at the trough of the bear market, before we tripled the market, it wasn't quite sending a resounding buy signal. So that's why some people are a little skeptical of it.
So what does Shiller say about this?
He himself, he says, look, this ratio, he talked to Bloomberg Radio a couple months about this, and he said, the ratio is above average. It's one of the highest it's been ever. But he says the real wild card is these sort of perpetual low interest rates that are sort of screwing up a lot of these financial models. And PEs, a lot of people believe, are very closely tied to interest rates. As interest rates go up, fixed income becomes more attractive. So you're going to pay a little bit less of a premium for stocks. And he's saying with rates as low as they are, he kind of shrugs and say, he hesitates to tell people to get out of the market because it's been...
There's that caveat, yeah.
Right, yeah, and it's been, this ratio has been above average for a long time now, so it hasn't necessarily, it's been flashing this danger sign for a while now, and he's a little wary of interpreting it as a sell signal at this point.
It's interesting. I mean, almost every data point, there is so much... You have to put it all in context, right? I mean, it's not so black and white here.
That's right.
But very interesting. Mike, thank you so much. Mike Regan. And you can read his story in the July-August special rivalry issue of Bloomberg Markets magazine.